Most people, including probably the Federal Reserve, are aware that the Fed is currently in between a rock and a hard place, with a deflationary death spiral on one side and a hyperinflationary collapse of the currency on the other side. Where people do tend to disagree is what the Federal Reserve should do in order to try and thread the needle between those two things, number one, and then number two, what they will do, not just what they should do. The other thing muddying the waters is personal preference about what people wish the Fed would do, because a lot of people disagree about the Federal Reserve easing conditions to bail out the economy, but at the same time, they're upset at the Fed for tightening conditions and potentially causing more economic pain, when in reality, that's the healthier option long term, even though it might be more painful short term. Regardless, the FOMC minutes recently came out detailing some thoughts about what the Federal Reserve might do with monetary policy moving forward, and I am here to tell you that what is likely to happen is that the Federal Reserve is going to continue to fight inflation until they win, and the problem with that is that they're going to tip the economy over into a depression. They're going to fight inflation hard enough to spill things over. They're going to overdo it. And the real problems start after that. Ready? Let's dive in. The FOMC minutes recently revealed that the Federal Reserve could hike rates more in the future, but the pace at which they're doing that could slow down significantly. Now, many people, especially in the mainstream financial media, were running victory laps when the inflation numbers came out for July, because they showed zero inflation month over month, and they also showed a smaller year-over-year number compared to June. However, the Federal Reserve said that they saw little evidence in July that U.S. inflation pressures were easing. Part of the reason for this is that major categories still experienced a lot of inflation. Even though the basket overall was flat, you still had the essentials, things like food, experiencing record high price hikes. Because of this, the Fed is expected at their next meeting to hike interest rates by either 50 or 75 basis points. However, with U.S. retail sales stronger in July than what was expected, with record high inflation at 10% in the UK, and with job and wage growth in July exceeding expectations, it looks like a 75 basis point hike is more likely than the 50 basis point one. Now, you're probably saying it doesn't even matter, because if they raise interest rates by 1%, 2%, 3%, they're still nowhere near the rate of inflation, and so we don't have real positive interest rates, therefore it's still inflationary. And that's just not the case. In order to understand why, we have to take a step back and understand how money flows through an economy. Let's start off by imagining our hypothetical gold standard village. When you have a gold standard and people are trading gold coins, the money supply, let's just say, is perfectly flat. That means the money supply doesn't grow and doesn't decline. That means that prices, on average, cannot continually go up because there's not enough money to support those higher prices. At a certain point, those higher prices will not be able to be afforded by anybody because there's no more new money able to be used to buy those things at the higher prices. Further than that, the development of new technologies and the growth of real wealth by building more houses and growing more trees and growing more cattle and your farms and your inventions and your machines, as you grow the stock of wealth, there's more wealth relative to all the money. Therefore, the prices of everything actually goes down because you have an abundance of stuff compared to the money. However, if you want prices to continually go up, you have to continue to expand the money supply, because the more money that enters the system, the more it can bid up prices and continually support those higher prices. And then the more money that comes in from there, the prices can go up even higher because there's more money to go around to continue to afford to buy things at those higher prices. And remember, this is money supply relative to the supply of all goods and services. So if you want the prices of everything to go up, you have to make more money at a faster pace than we're making more stuff. If the money supply and all the stuff is growing at the exact same pace, then you will have price stability, not deflation and not inflation. So what has the money supply been doing recently? Let's take a look. Since December of 2021, you can see here the money supply as measured by M2 has done absolutely nothing. It's fluctuated up and down a little bit, but it has moved sideways. If we zoom out here, you can see that for years the money supply moved up and then it had a big spike in 2020, and then the rate at which the money supply was increasing stayed at a faster rate than it was for years before until we got to the end of 2021 where the money supply growth flatline. And so if you do not have an expansion of the money supply, again, relative to the amount of goods and services, the stuff, if you do not have an expansion of the money supply, prices cannot continue to go up. We also know that money flows through the economy in 3 stages. First, it hits asset prices, then it hits goods and services, then it hits wages. So whether we're going to look for inflation or deflation, it follows that path. Look back here at this chart of the money supply. We had a massive increase in the money supply in early 2020, and very quickly it hit asset prices. We had an absolute explosion in stock prices, real estate prices, crypto prices. Everywhere you looked, things were going up, but not goods and services. We didn't have any CPI inflation during that time. It took a while for that inflation that hit assets first to then filter over and start to hit the prices of goods and services. And we have had inflation in goods and services, high inflation, for 7-8 months now. Meanwhile, we've had asset price deflation. Why is that? Take a look back at the money supply. Ever since December of 2021, the money supply stopped growing. Now, if you're going to go buy a stock, you're going to buy that stock because you expect that stock to go up, right? That's the only reason you make an investment, is to make a profit. If, though, you expect that stock to not move at all, you are not going to buy that stock. In fact, you're going to sell it because you would rather hold the cash, which won't fluctuate in value relative to itself, versus a stock, which could drop in value relative to cash. And so when the money supply stops growing, it stops filtering through to assets first, which means the asset prices stop growing. And if asset prices are not growing anymore, that prompts selling, because the only reason to own an asset is if the number goes up. And if the number doesn't go up, you sell it, which does what? Makes that number go down. So because we've had just a flatlining in the money supply growth, not even a drop, we've had a flatlining in the money supply growth. That means we've had deflation in asset prices since the beginning of this year. And we know that whatever the money supply does impacts asset prices first and then goods and services. So we are going to experience, on average, deflation in goods and services in the CPI. Now, I'm not saying everything, because things like food will probably continue to go up because there are many other factors prompting the prices to go up in food. However, on average, we are going to start to see demand destruction take place. We're going to see painful choices being made. People won't be able to afford things because the money supply, look again, it hasn't been growing. Therefore, there is not enough money coming in to the economy to continue to support purchases at increasingly higher levels. So on average, the CPI will drop. And because the things that people need the most, like food and shelter and energy, will continue to experience demand, we'll probably continue to see higher prices in those areas, again prompting the Federal Reserve to continue to tighten in the face of these deflationary forces that they don't realize are building up behind them. And that's where we get to the third place where it hits wages, because we've seen the wage price spiral take place for the last year or so as wages have increased. Not as much as inflation, the CPI, but wages have been increasing because there's been new money entering the system to support those wages going up. But that has not been the case since December of 2021. We have not had new money entering the system. The amount of money has flatlined, which means that we started this year to see deflation in asset prices. We're about to start to see deflation in the prices of goods and services. That will result in deflation in wages, which means pay cuts, layoffs, unemployment. And that is where we start the depression, because we're already in a recession, but we're about to see the full force of all the pent-up deflationary forces hit the economy all at once. As we're seeing record high debt, interest rates on that debt starting to go up to levels that they haven't been in decades. The money supply is not growing anymore. We've already seen that hit asset prices, which is going to filter over through the economy as it usually does, and the Federal Reserve will be blindsided by the swiftness of the depression that starts to hit our economy as unemployment and economic pain rolls across everywhere and rolls over everything in sight. And the reason why I said that is going to be when they're going to make their biggest mistake is because at that point, they should do nothing. They should stop impacting monetary policy. They should stop trying to change interest rates, stop trying to affect the money supply. They should take a step back and let the depression roll throughout the economy, regardless of how painful that is. Because the fact of the matter is, it will destroy any economic actor who has been over-leveraged, who has made choices to take on too much risk and to not have any savings in reserves, and who has mismanaged wealth. Those are the actors that get taken out in a recession and in a depression. But people do find their way back on their feet, and the companies that survive absorb the assets, the real goods and services of the companies that don't survive. New jobs are created in fields and in jobs that are actually productive. Instead of destroying wealth from the economy, they create new wealth. It creates a much stronger foundation, and it creates incentives for the entire system to save, be conservative, not take on too much leverage, not take on too much risk, and make sure that you're managing your wealth wisely because there's no bailout coming. And so if the Fed were to step back at that point and not do anything, we would be much better off long term. But they most likely won't, because at that point, inflation won't be a problem anymore. We will have deflation. So they will have the excuse that they've always had for decades to step back in and bail the system out, because they're going to say, we don't have inflation right now, so we can start printing money again. And that is when we'll have to worry about hyperinflation. So inflation is going away temporarily. Right now, we're going to have a deep deflationary depression, and then hyperinflation will set in. And if you would like to protect yourself from crazy hyperinflationary events or deflationary death spirals, you know I've got a course built just for you. We're on the first week launch of this, so this discount is only available for a few more days. Link is in the description below. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.